Media conference about the Bank for International Settlements March quarterly review. On the call today are Claudio Borio, Head of the Monetary and Economic Department, Shin, Economic Advisor and Head of Research, along with the authors of the special features. Before we begin, I'd like to reiterate that only the comments from Mr. Borio and Mr. Shin are on the record. Any author comments are strictly off the record, not for quoting or attribution. This media conference will be recorded and the on-the-record sections will be published on the BIS website later today. The embargo on the BIS Quarterly review, the media release and the on-the-record comments lifts today at 1 p.m. CET, Basel time. Mr. Borio and Mr. Shin will give brief introductory remarks and then we will open the floor to questions on the overview first. We'll now start with the introductory remarks. Claudio, the floor is yours.
Thank you, Krista. The latest quarterly review examines market developments from early December to the 22nd of February. During this period, the prices of risky assets rose further. On the back of continued strong monetary policy accommodation across the globe, they responded to a brighter economic outlook. This reflected prospects of fiscal expansion and mainly positive, if uneven, pandemic-related news. High risk appetite underpinned robust corporate debt issuance, especially by lower-rated firms, as well as buoyant activity in initial public offerings. It also contributed to a surge in special-purpose acquisition companies, or SPACs, otherwise known as blank check companies. Credit spreads narrowed further. Many stock indices reached all-time highs, reviving memories of the late 1990s tech boom. Retail investors flexed their increasing influence on market dynamics. As one of the boxes in the overview document, these investors use leverage, buy and sell options, and rely on social media platforms to coordinate their trading strategies. Their growing activity can at times amplify volatility. Risk appetite also supported broadly positive sentiment towards emerging market assets, particularly in East Asia, and encouraged further portfolio inflows into these economies. Importantly, the reflation trade gained momentum. As the likelihood of strong US fiscal expansion grew, long-term bond yields backed up and the yield curve steepened, both in the United States and Europe. With investors becoming increasingly uneasy about inflation prospects, measures of inflation expectations and of the inflation risk premium climbed. The recent market jitters confirmed that the backup in bond yields and reflation trade are casting the financial market outlook in a completely new light. I would also like to draw your attention to some of the other boxes in the overview. Box A looks at the drivers of high equity prices. It finds that stock returns are more sensitive to monetary policy news when interest rates are low and valuations high. Box C examines banks' recent loan loss provisioning decisions, which represent the first major test of the new accounting standards for expected credit losses. Box D analyzes the reasons for the widening gap between the nominal yield on fixed-rate bonds and the real yield on inflation-linked securities in the United States. I now turn to Hyun to present the special features.
Thank you, Claudio, and thanks for joining us, everyone. It's been a year since the financial turmoil of last March, and the passage of time has given us an opportunity to look back and learn some lessons on the functioning of so-called non-bank financial intermediaries, or Nbfis. And three of the special features in this issue of the quarterly review fall into this category. The piece by Avalos and Shah analyzed the withdrawals from money market funds in March 2020. What they find is that large investors appear to pay little attention to the liquidity conditions of individual funds. And for their part, when redemption surged, the portfolio managers responded by hoarding liquid assets. In the second feature, Aldasoro, Erin, and Huang look at what happened to dollar funding of non-US banks. And what they find is that these dollar liabilities of these banks grew during last year, but there was a change in the composition. After March, there was a shift in the source of the dollar funding away from money market funds to the deposits of non-bank financial institutions. In the third feature, Karanfil Todorov zooms in on the ETFs, or exchange-traded funds for bonds. ETFs are better known for stocks, but they're also very important in the bond market. But the special nature of the bond market, the fact that bonds don't have the degree of standardization of stocks, means that the process of the creation and redemptions of ETF shares uses only a subset of the underlying index. And this has a number of consequences, including allowing bond ETFs to support market functioning by absorbing shocks. And last but not least, the fourth feature switches to the current state of corporate credit. Mojon, Rees, and Schmieder project potential losses on corporate credit, and they do it by sector. And what their analysis suggests is that credit losses could be lower this time round than during the great financial crisis of 2008, partly because the sectors most affected by the pandemic account for a smaller share of the total corporate borrowing as compared to the pre-GFC period. So let me hand over to our moderator.
Thanks, Hyun and Claudio, for the introduction. So now we turn to the questions. To ask a question, please use the raise your hand function in WebEx, and we'll unmute your line, or type your question into the chat as a message to all panelists. And if you raise your hand in WebEx, please do lower it after your question. If you're dialing in by the phone, you can email your question to press@bis.org. And just a reminder, we're taking questions first on the overview, and we'll come back to the special features later. So the first question we have is from James McIntosh at the Wall Street Journal. And we'll unmute your line, James. Please go ahead.
Hi, I do have a further question on the money market funds point for Hyun, but if you want that later, my question on the overview is really that you seem fairly balanced. On the one hand, everything's wildly excessive and completely overdone, and on the other hand, valuations are entirely reasonable compared with what's going on in the bond market. Are you saying that we have both? I mean, the classic phrase is a rational bubble? Is that what you're talking about here? Or are you saying that because of wild excess in the bond market, everything else is also showing wild excess?
Well, thank you, James. I think we've already been here. As we said in the previous reviews, we see a certain daylight between valuations and future economic prospects. To do that, we cannot just look at equity prices. We have to take a broader view. We also look at what's going on in corporate markets. And indeed, corporate spreads are very low. And in general, we see a number of signs of froth, as you mentioned in your introduction. Yes, it is indeed the case that if you look at a number of things, particularly equity prices, I would say less so in the context of corporate spreads, you can justify the valuations that are there. But I think there is a big difference now compared with the past or our previous overviews. And that's basically that before this overview, investors just saw low rates as far as the eye could see. Whereas now they have started having doubts about how long those conditions will last. And of course, as I said in my introduction, that does mean that the outlook for financial markets, we should see it in a completely new light. And it is not just a question of what will happen to the economy or to inflation, but it's going to be importantly a question of what's going to happen to interest rates.
Thanks, Claudio. And James, we'll come back to your question on the money market funds in a minute. That's okay, I've made a note. Jack Schickler from MLEX also has a question. Please go ahead, Jack.
Yes, thank you. I was very drawn to your comments on GameStop and social media-driven price volatility. You refer to the actions of retail investors as coordinated, but there's some question about whether they are coordinated enough to prompt market abuse or other kind of similar investigations. Are these rules up to scratch? I mean, if something that is technically not illegal can generate these wild and quite risky episodes of volatility, do we need to look again at those rules?
Well, first of all, let me broaden the question a little bit. The role of the retail investors in financial markets, particularly in equity markets, tends to become much more prominent during periods in which there is euphoria, and we have seen it this time as well. Now, there are things that are similar to what we saw in the past. One is the use of leverage. Probably the main difference this time is that not only were they borrowing or have they been borrowing money in order to invest in the equity market, but that they have been using more than in the past options. So that's embedded leverage. So you have twice leverage if you borrow and then invest in these stocks. So that makes for the possibility of amplifying volatility. What is indeed new, which is what you mentioned, is the fact that they have started coordinating their activities on internet platforms. And that's indeed something that has amplified further the impact that they've had, mainly on individual stocks, because they cannot do it on the market as a whole. I think as to your specific question, which is whether rules are up to scratch and whether they have been going beyond just normal practices and that they are colluding, that's really something for the securities regulators to decide and assess.
Thanks, Claudio. We have a question that's come in over the chat from Natalie Olaf-Ors from Agence France Presse, and she asks, why does the reflation trade matter and what impact does that have on the outlook looking forward?
Well, the reflation trade matters a lot for the reasons that I think were apparent when I answered the first question, is that many asset classes are the valuations of many asset classes are predicated on low interest rates. So if those interest rates change, then the outlook for those valuations and for the asset prices changes. And indeed, as I mentioned at the beginning of my remarks, we do have two boxes in the overview that look at these things in much more detail. One examines the reasons, the factors behind the increase in bond yields, to what extent they have to do with inflation expectations, to what extent they have to do with compensation for inflation expectations, for the risk of inflation, and also as a result of market factors, the supply and demand, both for fixed income nominal bonds and for TIPS or real bonds. Because of that, you also have the other box that looks in particular at the extent to which equity prices are responsive to news about monetary policy, therefore about interest rates, when price-earning ratios are high, so when valuations are high. And indeed, we find that they are particularly responsive to those, sensitive to interest rates. So if you take these two factors together, you will see that the future path of interest rate is critical to understand what will be happening to the prices of risky assets.
Okay, thanks, Claudio. We have another question from the Wall Street Journal from Joseph Sternberg. He asks, regarding the rising role of retail investors at the moment, is this across the board, or are there certain economies or markets where this effect is more pronounced?
I think that in general, in general, this is indeed across the board. As I mentioned earlier, that's precisely what happens when there is euphoria in the markets. I remember that one of my colleagues used to tell me that whenever a taxi driver starts talking about what's happening to the stock market, then it means that something significant is going on. Now, of course, their role will be larger in those markets where it's cheaper to trade, in those economies where indeed, some of the media platforms are more in use, where the ability to borrow and use options is greater, and therefore that is going to be to some extent market and country specific.
And just to reiterate for anyone who may have joined late, the contents of the media conference are on the record until 1 p.m. when the embargo also lifts on the quarterly review. The data behind the graphs and the translation of the press release are also available on our embargo site. And if you would like to ask a question, you can either raise your hand and we will unmute your line in the teleconference. You can write it in the chat, or you can send us an email at press@bis.org. So we have a question from Mark Jones from Reuters in the chat. He asks, how high is the risk of another taper tantrum? How important is it that this is avoided after the huge rise in debt levels caused by the COVID pandemic?
I don't think I can say much more than what I said earlier. It would all depend on the path of bond yields will depend very much on the evolution of the economy, on the evolution of inflation. Of course, there is quite a lot of leverage out there, so there is tinder to light the fire. Of course, central banks are fully aware of this. And then the question is going to be, if ever markets tumble, what their response will be. And we know already the answer, in the sense that they have a clear mandate, which is their lodestar, both from the macroeconomic perspective, what's going to happen to inflation and output, and what's going to happen to the system, financial stability. And they will have to work out what that is, the implications of that for their objectives, and respond accordingly.
Okay, thanks, Claudio. If there are any more questions on the overview, please raise your hand now or send us a message. Otherwise, I can see that we have a few questions coming in about the special features. Any takers for the overview? Okay, so we'll go to the special features, and we'll go first back to James McIntosh of the Wall Street Journal, please, who had a question on the money market funds feature. Can you go ahead, please, James?
Yes. Yeah. It's a very interesting look at it, but the conclusion appears to be that, well, the conclusion is that the central banks were right to act as market and the liquidity stress. But I'm interested in your view on, in future, is the answer to more secure like the banks, which didn't contribute to this, or is the answer just that central banks should continue to act as market makers of last resort for the money market funds? There's obviously two different approaches one could take it.
I'm not sure that we heard all of your question, James, because we had a bit of interference. But Hyun, would you like to give it a shot anyway?
Yeah.
You've got the gist of it. Okay, go ahead.
Yeah, thanks, James. I think I'm not sure that we can, we can have a sort of cut and dried answer along the lines that you've suggested. I think it's a little bit. I mean, there are more factors involved here. For one thing, we need to look at the short-term funding markets, more broadly. And money market funds also serve both as funding vehicles, especially for banks, but also as a place where savers, as a place where investors can have liquid assets at their disposal. in terms of the funding function of money market funds, one that the special feature on dollar funding would also be relevant. In terms of the liquidity management function, both bank deposit accounts and also the government securities money market funds would also be relevant. What we can say is that when we have an episode like March of last year, when there was a very broad-based dash for cash, so-called, it could be that small differences in the composition of the assets of money market funds would be less important than the imperative to get into very liquid assets. Now, what is the right response? I think one thing that separates banks from money market funds is that banks are elastic structures, and that they can create overdrafts, they can create these deposits to meet the increased liquidity demand. And in that respect, the central bank is also, the best example of that, in that the central bank can create central bank reserves to meet this greater, liquidity need. So what I would say is that it's a combination of, I think there are several lessons here, but perhaps the one lesson that stands out is that in a broad-based dash for cash episode, small differences in the liquidity profile of the assets of these money market funds, would not be a huge discriminant, in terms of how much redemption takes place.
Okay, thank you, Hyun.
So is that you don't have a view?
I think we need to look at this both from what is the market structure. So, for example, I mentioned earlier short-term funding markets. Money market funds are not the only holders of commercial paper, for example, and so there are there are issues here about how do you increase resilience in the short-term funding markets. One example from the GFC, it didn't happen this time, but one example from 2007, 2008 was that money market funds then were important funding vehicles for European banks in cross-border dollar funding. And so there are repercussions to the banking sector. So, we need to think of both resilience of the funds, but also resilience broadly of the funding markets, more broadly. So I don't think there are any quick fixes.
Thank you. And on the dollar funding question, we have a question from John Rees from S&P Global Intelligence. He asks, how significant is the shift in dollar funding for non-US banks from money market to Nbfis?
Yeah, so I think this is a shift that we have noted before. We had a box from 2017, exactly 4 years ago, where we first mentioned this trend. I think the answer to your question depends very much on the specific form that these deposits take, what the maturity is and who the depositors are. If we reach the conclusion that these deposits are sticky forms of funding, in other words, the depositors are not liable to withdraw very quickly, or are more patient investors who are willing to keep their funds in the bank for longer, then this shift would be, I think, a desirable shift. We don't have that level of detail in the data. I think this is an area where we need to monitor for future sort of data to come in. But in general, I think the lesson is that the banking sector this time around was far less exposed than it was during the GFC. In fact, they were able to provide a cushioning role rather than being part of the problem. And I think the broad shift towards deposit funding, I think, is a reassuring sign that even if there are institutional reforms that mean that money market funds play less of a role, that the funding that goes to the banking sector will not be an issue.
Thank you, Hyun. Can I ask if anyone else has questions about the features? If you can please raise your hand, send us an email, or type your message into the chat. And there are a few more questions that have come in, but they're more general topics. So this is the last call then for questions on the special features. Just a reminder for anyone who may have joined late, this media conference is on the record but embargoed until 1 p.m, which is 1 p.m. Central European time, which is the time that the embargo lifts on the quarterly review. So I don't see any other hands raised, so we'll go then to the more general questions. So from Markus Fruauf at the Frankfurter Allgemeine Zeitung, he asks if there is concern about the special purpose acquisition companies, SPACs. Claudio?
There are positive and less positive aspects about the SPACs. I mean, the positive aspect is that they are an easy way for companies to go to the market, as we say in the overview. The less positive aspect is that they are yet another sign of the exuberance in markets, and we should bear that in mind when we assess their overall impact on the financial system.
Thank you. And a question from Catherine Bosley from Bloomberg. She says, the BIS has frequently in the past stressed the importance of leaning against the wind with interest rates. Inflation expectations are rising. What is the appropriate policy response? How long is this spate of higher prices likely to last?
Let me start from the end. How long is higher prices? How long are they going to last? Well, I think I answered that in my previous remarks. It is not really possible to say how long they will last. What one can do is to identify the conditions under which they would last, and that's what I tried to do in the first part of my answers. Now, when it comes to leaning against the wind and all that, I think central banks are fully aware that low interest rates, exuberant markets, not so much equities, I would say, but other markets, including credit markets and real estate markets, can have an impact on the macroeconomy further down the road, so that they boost economic activity in the short run, but in the longer run, they might actually act as a kind of headwind on economic activity. They have their objectives, inflation, some of them have output. The question is how to make sure that they can achieve those objectives in a more sustainable way. And here there is indeed the trade-off that I mentioned, and central banks are aware of it, and they have to balance the various objectives, and this is a delicate balance that they're trying to deal with in the most effective way.
Thank you. We have another question from Ignacio Farisa from El País. He says the report points to the fact that global financial conditions turned less favourable for emerging market economies, and asks what should we expect for the near future?
Again, we don't make forecasts. So, but what I can say is that emerging market economies have much stronger policy frameworks than they had in the past. They have been more prudent when it comes to fiscal policy. They have been They have monetary policy frameworks that are more conducive to stable inflation. They have added to all that a whole set of macroprudential tools to allow them to balance better financial stability considerations on the one hand with standard inflation considerations. They have been using FX intervention to various degrees as a quasi macroprudential tool, in the sense that they have built up resilience, just as you would with higher capital, and they have tried to use it, or they have also used it to some extent in order to lean against the increases in the increases in the dollar, in their domestic currency exchange rate, which could actually fuel and ease domestic financial conditions. So this basically means that whenever global financial conditions turn, and one presumably will, we know that at some point they will turn, they will be in a better position to withstand the change in the tide.
Hyun, would you have something to add on emerging markets?
No, I think that's a pretty full answer.
Okay, so I'm not seeing any other hands raised or questions in the chat, so this is the last call. If you do have another question for any of our speakers, please raise your hand or type your message into the chat. Oh, James McIntosh, is that another question from you, James, or is your hand raised from the last time?
Yeah, if I can back for Claudio from the very first question, if that's all right. But I suppose I'm interested both in your concerns, higher bond yields in particular, will hit the stock market by more than it usually does, which makes sense, a duration effectively both duration. But against that, the reflation trade that you also talk about, of course, is what drives the rates up. How do you think those things balance out, or do you have a view on how those things balance out, or does it really come down to the makeup of different stock markets?
I'm not sure what you mean by balance out. Clearly, these are factors that increase the sensitivity of equity prices to movements in interest rates in one way or the other. But let me make a more general point. Of course, people are focused on equity markets because they're more exciting than other markets, particularly corporate markets, where you don't see movements to the same extent. But I would say that from a macroeconomic perspective, one should focus more on credit markets than one does on equity markets per se.
Okay. James, do you still have your hand raised? You have another question?
No. Thank you.
No. Okay. All right. If there are no further questions, I think we'll wrap up the teleconference now. So thank you to everyone for dialing in. We look forward to reading your articles at 1 p.m. And also a reminder that you can follow us on Twitter, on YouTube, now also on Instagram, to keep in touch with all of the work that we're doing here. Thanks, everyone.